Hello guys, welcome back to Financial Options with Thumper. And today we're going to be talking about how to manage a trade that goes against you. I think this is a very important thing because no matter how safe you are on trades, you're going to have something go against you. And if you know all the options available to you to manage that trade, it'll help you be successful in the long run. So with that said, let's get started here. Over the course of this video, what we're going to be talking about is the wheel. We're going to talk about max loss versus probable losses. We're going to talk about rolling. We talk about a strategy called double down roll, and then obviously another option you have is to take a loss. But let's go ahead and get started with the wheel. So the wheel is a strategy that is great for beginners. Running the wheel, I'd recommend to anyone new to options. What you got to do is you find a stock that you wouldn't mind owning at a price. You sell a put against it. If you get it signed, then you sell covered calls against that position. And what's great about the wheel is you're playing both the put and the call side. You're going to learn how those trade mechanics work. And assuming that you're fine owning 100 shares of that stock, like, you really can't lose. Because if you were just buying the stock out anyway, any movement in the stock, you'd be basically capturing yourself to the downside anyway. And what's nice also about the wheel is that it's easy to track. You pretty much know what your next move is going to be. I'm going to show you a flow chart that shows that. And plus, look how happy that Bitmoji guy looks running the wheel. And so now the wheel, like, this is a flowchart I made for a friend when I was introducing him to options. And it's very easy. Like, it's very, event driven. So to start off the wheel, you sell your cash secured put on a stock you would not mind owning, usually a large cap stock. When it comes time to expiration, just ask yourself, did it expire? If yes, congratulations, you made money. Go back, sell a cash secured put. Come back to the next decision tree. Did it expire in the money? This time, let's say no. Is the stock above break even? If yes, you have the option to sell those 100 shares. You've come out with a profit because it's above your break even, and you're back to selling your next cash secured put. Let's say you do this again, get down here, and the answer is no. Now you're in this last little wheel. So you sell your covered call against it at break even price, or at your strike price. I prefer doing the strike price, but we're going to do that in a little bit. And ask yourself, did it expire in the money? If yes, congrats, you made money again. Start over at the beginning. If not, sell another covered call. Sell another covered call. While you're doing this, is you're lowering your cost basis, and eventually you can sell at a strike price below the stock price, and your expire in the money, and the shares will get called away. So you made your money, and you're back here. Now, one thing that I always cringe at is people love to say, you know what, I'm gonna buy 100 shares and then sell the covered calls against it. So you're starting at the wheel at this point. Like, why are you running that wheel? Like, over here is more capital efficient. You get the same risk profile just about, but it takes less cash and you can get out quicker without owning the shares. So just something to think about. Start here, work your way down to this area. When I'm running the wheel, I prefer to just run this route here, or even this route. I hate being stuck in this one most of the time. And another thing that you could try doing, if you have extra capital available, is if you get stuck in this area, you can sell another version of the wheel going. So you're selling a put at a lower strike price. And then if that thing is assigned, you lower your cost basis between the 200 shares, and that should help you get out of the wheel too. So another way to attack the wheel, I'll call that the aggressive wheel, when you start selling another contract while you're stuck on a wheel in the position. One thing I'd recommend is take a screenshot of this, print it off, and put on the wall. And when it comes time to expiration, you can literally just run through this flowchart. Now, I wanted to go over a couple examples here. So here's an example I did on Palantir, and I started with selling a put at the 23.50 strike. I didn't mind getting assigned at the time. I thought that'd be the low point. If assigned, I could do the wheel on, was my strategy going into this trade. So anyway, time passes. I did get assigned on this trade. And I think it finished at around 23 when I actually got assigned. But I tried to wait a little bit to see if I can get a price movement up and capture some more premium. Like, don't wait when you're doing the wheel. Like, you're just trying to time the market, and we all know you're not really supposed to be trying to time the market. So I actually got less premium because I waited to try to wait for the price to go up anyway. So after I got it signed, the next trade was to sell a call against it. And I chose the same strike price that I got assigned at, because even though my cost basis at this point was 23, because your cost basis is your strike price minus premium received. So there's my strike price 23. I received 51, so my cost basis is 23. But if you're selling at your new cost basis, you're giving up that premium that you already covered. So if you can sell at the same strike price, do that, then you're not giving up that 51 bucks. And that's because of, if you're selling at the 23 strike, your losses on the shares, your capital gains loss, or your capital loss, will count against your premium. So that's why I try to stay at the strike price I get assigned at. Although it's nice to know your cost basis going forward, so that if the stock goes too far down, you can lower it. Anyway, back to this example. I sold the call, got 57 cents. It finished at 23.07. Around 23.07. So I still had the shares. And so what did I do? I sold another covered call. I'm stuck on that bottom wheel. I'm still in it right now and waiting for this to go out. What's also nice to see is, like, since the stock price was close to my break even here, I got a lot of premium. So that's a nice gain if this expires worthless. And if it doesn't expire worthless and it goes in the money, the shares get called away, and my profit is all this over here. So when looking at your cost basis, because you're going to want to know that, just do that for every time you sell your new call. Subtract that from your previous basis. Don't forget about commission. And you can see, like, each row, like, your cost basis goes lower. So at the time of this screenshot, the current stock price is 22, but my cost basis is 20.85. But yet I'm still selling my strike price for my strike price for my covered call is still at 23.50, protecting all this profit they were getting. Now, just want to take a second to let you think about this. Okay, to buy 1,000 shares at 23.50, I spent $23,500. Through selling premium, I've gotten 26.83 back, and I still have those 1,000 shares. Now, had I not been running the wheel, and I wanted to buy 1,000 shares of Pelletier when I opened this, on that date, it was 25.35. If you look at the price now, I'd be looking at a huge loss of, well, 25.35 minus current price, 22.35 times, we said 1,000 shares. I'd be looking at a $3,000 loss. But because I've been running the wheel on it, my cost basis is actually lower than the current price, so I'm looking at a gain. So had I just bought and held the shares, I'd be in a losing position, $3,000 worth. But because I've been running the wheel on it, I'm actually, like, in a profitable position at the time of this screenshot. The next thing I'm going to do is, like, just go through this Apple one. This is another one where stock price was at 131, sold 116.25, and you could tell I got assigned. So then I just turned around, sold the covered call. It expired worthless, sold another covered call. And you see, like, over the course of, like, these 4 trades and 2 months, I received $9.86 in premium. But what happened was, the last strike I did was 116. It's at 116.25. So I actually lost 25 bucks on the stock shares themselves. So you add those together, and I end up getting like an 8.27% return from running the wheel on Apple. And if you want to, like, have your mind blown, think about this. Like, that's 8% in just 2 months. Like, the wheel is powerful. Use it, and it's great for starting to learn. Next thing I wanted to talk about was max loss versus probable worst case loss. So when you sell a strike, everyone tells you your max loss is the strike price times 100, but this only happens if the stock goes to zero. If you're playing large cap stocks that are well known, have established business good practices, then it's not likely to go to zero. So start thinking about what your probable max loss is going to be, and I'm going to take a look at the chart here to kind of show you what I'm looking at. And we even have, like, an event recently, so you can see what happens in the event of a black swan to help you predict what your max loss would be. So here we're looking at Coke. We're looking at the 2-year chart, and you can see like back here. Let's say you time the market horribly. You sold a put at this area, and if you were selling at like 70% probability of the money, you'd probably be about this range. So stock price, let's say $55. And let's say you just so happen to have your expiration right when this dip happened, 36. To calculate your loss on that at expiration, we know it's just going to be intrinsic value. So we said 55 would be like your strike price that you sold at. You are closing at 36.27. So your max loss on this position is $1,800, whereas your max loss at the position was actually $5,500. So what you're actually risking is less than the theoretical max loss. And that's something to keep in mind, because when you look at other videos, people say any trade that you do, try to keep the risk down to like 5% of your portfolio value. And they're talking about your actual like probable risk, not, oh, this is going to be 6,000. No, it's really 18. And that's in the black swan. Now, if you look at Coke, you're looking for like a month where like it has a big drop. Looks like here it had a big one from 50 to, what was that, like 43. So like an $8 move. That looks like an $8 move. Again, if you're selling at 70%, you'd be like $2 under that. So $8 move, but you're selling 2 under, so $6 between that and a month. $600 max loss is what you could typically expect playing Coke, unless there's a black swan event, which, I mean, it's a black swan event because it's rare. I think when you're figuring out what you can do, just think about that. Just something to keep in the back of your head. Okay, next up, rolling. I'm sure most of you have heard about this, but for those of you that haven't, is when you buy back your contract at a loss to fulfill the obligation of buying the 100 shares, and then you sell a new one in the future for a credit. And what I mean for a credit is you receive more on the one that you sell than you paid out to close your previous one. And what's important to get confidence in doing this is knowing why this works. And in order to do that, you have to think about what premium is made of. And premium is made of the intrinsic value, which is the difference between your strike price and the price of the stock below. And that value won't change when you go out in time, because by definition, it's just the difference between those two things. Extrinsic value, on the other hand, is going to be greater further out in time, because both implied volatility would be higher and time value is greater. So implied volatility is higher because realized volatility is usually lower than expected volatility. And when you're sitting at 0 days to expiration, like there's no volatility left, like, you know, the risk is low because we know what's going to happen to that contract. It's going to expire in the money. Whereas in the future, we really don't know. And then the other thing we have is time value. There's a difference between 0 days to expiration and 30 days to expiration. So those two things inflate the prices of the premium for the same strike in the future. So as long as you're playing on stocks that have a lot of liquidity, you should always be able to roll. I've never had an issue rolling yet. And I think that is because I play on stocks that have a lot of action on them. And so now we're going to go over like an example of a roll. So let's say I sold a put on Coke, 56 strike for 527. I don't even care what I receive. So I'm just going to say we just own it tough. Right now, we're about 4 days from expiration, and we're in the money, like by about $1.50 here. So we want to like manage this position because I don't want to own 100 shares of Coke. So one of the things I'd like to do when I'm in the money is to look at the value of the extrinsic value left on the contract. Sometimes it's worth it to wait the extra day or two because there might still be extrinsic value that can be burned off quickly. In this case, from this Thinkorswim picture, we can see the extrinsic value. Like, there's nothing there. Like, we can manage this trade now. If your platform doesn't have extrinsic available to you, let me pull up the calculator here. It's easy to find out. So you take your strike price, and I'm doing this with a put. Subtract your expected fill price. I think you probably get filled around $1.50 here. Let's go with mid price. And you can tell we're right next to the price of the stock in this picture, which kind of goes with the fact that we see that there's no extrinsic value left here. We see 2 cents of extrinsic value. So that's how you can find out how much extrinsic value is left if you don't have this column available to you. So if that's low enough to where it's not worth waiting, then get to work and start buying back that contract to fulfill your obligation. So you're going to be buying this back probably for a loss because it's in the money. On some brokerages, you're seeing an option called buy to close. Others, you can right-click the position and just choose close, and it'll pick the right thing. If you're doing it from the option chain, make sure you're buying back the same contract you sold. If you buy back the 5650 by mistake, you didn't close your position. You still have that obligation. So moving on, we're going to say we closed at a loss of 1.5. We're looking 1 week out here, 56. You can see the bid and the ask. We might look at filled at like 153, so we can be paid like $3 to wait an extra week on this position. But this column is probably out of the money. It's still 0%. That's doesn't seem really worth it to me. Like wait a week for $3 for a chance to get back out. Like $1.50 is pretty huge for Coke to move, apparently, according to the data we have here. So what I do is I'll look at the next week out. So now we're at 18 days out. And you can see we've got a little bit more premium. We could probably get filled at 170. So we'd be getting paid $20 to wait to be right again. Like that's how I view rolling is we're getting an opportunity to be right again. It's like saying redo, and you give me more money to do it. So this might not be a bad one to do if you think Coke is still going to be going up. But if you go further out in time, because there's more time in the contract, the extrinsic value is going to be even further. You can see we can probably get filled at $2 or even above that for the 56 strike. So now we're getting paid $50 to wait a month. I mean, that's a pretty good return for just sitting there waiting. But what I'd like to try to do when I'm going out a month is lower that strike price, because now I can sell the 55.50, get a little closer to the money. I can still get that credit, but I've increased my probability out of the money by about 7% in this instance. So that's something to think about. Look through. If you think it's close, maybe you can roll it out a week and just kind of get that extra week to be right. But you can go out like a month and the extrinsic value goes up. You might be able to lower your strike price and increase your probability to get out of the money. I'm going to go over some examples here. I had to dig pretty deep to find some examples, and I hate showing NIO. That's not a stock you should play as a beginner. It's not a good stock to be trading options on, but it's a good example for what we're trying to show here. So I got greedy. I sold a 39 strike on NIO when the stock price was only 80 cents above it. It was a short contract. I thought I can flip it for a quick scalp trade and make a little money. And boy, was I wrong. So that's NIO dropped to 35. So in order to roll it, the first thing I did was I checked to see what the extrinsic value left was. Well, if the stock is at 35, my strike was 39, there's $4 of intrinsic. I was able to exit at 4.19, so I only paid 19 cents in extrinsic value to get out of this position. So it was time to roll it already. And somehow I was able to get a pretty nice credit for just going 1 week out. And so I sold for $4.76. You see, got that nice, 50-cent credit or so. And I was able to buy that guy back out at 76 to get out of it quickly. So you can see I took a temporary loss, but not really, because I got that immediate credit back anyway, and came out with an overall profit. Here's another one, and this one kind of shows you can think you're safe, and stock can really say no, you're not. I sold a 75 strike put on SRPT when it was at $85 here for a little small premium. And then what happened was SRPT decided to just shoot down, and it got down to 71.48. And if you check your extrinsic value, 71.48, subtract that from 75, let's say that's 350, or yeah, about 350. I paid a little extrinsic value to get out of it. I mean, I wasn't too concerned about that. But I was able to roll it down 4 strikes here and still get a premium. And as you could tell, I was actually able to close it for a profit. So rolling is just saying redo, redo. But a thing to consider when you're rolling, I guess, how can I say this? I like to say separate your trades in your mind. Don't let one bad trade dictate what your next trade's going to be. So when I close this position, I already thought about, is my original trade thesis correct? Do I still want to play on this contract? Do I want to roll it because I think it's still going to go up? If the answer is no, don't be rolling this sucker. Like, you're just setting yourself up to keep catching a falling knife. Always reevaluate before you roll. Do I still want to be in this position? Am I still bullish on it? Or if you're doing a call, am I still bearish on it? Don't always roll. Think about, is my trade thesis still my trade thesis? Now we're getting to the double down roll. So this is a strategy I started using, and I haven't seen any YouTube videos or anyone talk about what this is. If there's an actual term to it, like, please let me know and put it in the comments. Otherwise, we'll call this the double down roll. And so essentially what this is when rolling, add contracts to your position. You collect more premium, so you can be rolling for a credit, and you can lower your strike significantly, and you might be able to bake more premium in, so you're still coming out with more profit over that time. Oh, forgot to put that in there. If you are finding this, enjoying this content, or finding something useful, like, take a moment, like, subscribe. There'll be more videos. I'm trying to jam pack these with a lot of information. If you can just walk away with one or two things, like, it's worth a watch then. I hope, like, you can take something away from this and put this into your trading tool bag. I want to show an example. So here I found one on Zoom that I did. And this one actually really surprised me. So Zoom was at 404, it's in the 400 range. And I sold a 320 strike. Like, it's not going to drop 80 bucks, right? Well, it did. Like, no matter how safe you are, the market has its own mind, okay? Always be prepared to have your plan B, know what you're going to do, know how to do all these different things to manage your position. It's going to help you immensely. So anyway, back to this example. I actually closed this. I rolled this one early because the stock price dipped. I didn't want to be holding that 404. At the time, I think March here, I was getting tested on some margin expansion. So I also wanted to alleviate some pressure on that front. So rolling this position just made sense to me at that time. Not just for the position itself, but also for my portfolio as a whole. So that's why I was doing this one here. And I had to buy this guy back for $21.90. Like, $16.40 loss right there. But because I'm rolling it, I know I'm going to get a credit. I could have rolled it to the 320 strike again. Probably would have been able to get 23 for it and just done one contract. But instead, I wanted to lower my strike price. In case Zoom kept going down, I didn't want to, like, be left in the dust. If it goes too far past and you're too deep in the money, you might have a hard time rolling later on. So here, I add another contract. By doing that, I was able to sell two contracts at a much lower strike price for $2,480, which is more than I bought out for and more than my loss here. And time went on. I decided to close it early at $1.75, although I think I would have been safe to just let it expire. Just lock in that gain and be out of that position and start fresh on the next play. So that just kind of shows you the power of, like, adding a contract. You don't always have to double. If I had two contracts with Zoom, adding one contract to it will allow me to lower that strike price significantly. And I should probably pull up, like, an options chain here, but you can see the probability of money increase drastically if you just add one contract. But in order to do that, you have to be trading small in the first place. If I sold 10 contracts here, adding one contract to it is not going to do squat. So trade small on a lot of positions. When one goes against you, manage it. And if you have this as an option, like, this will help you get out of the position quickly. Otherwise, you might be rolling at the 320 strike for a couple months, tying up that capital. The last option you have available to you is take a loss. Like, it happens. We're not always going to be right. And you don't want to spend too much time defending a losing position. And so for me, one of my first big losses was on Beyond Meat. I learned so much from this trade. First off, I sold this on 11/9, expired 11/13. But I did this during earnings. Like, I don't have contracts on during earnings anymore. And this one kind of set me straight on that. Before that, I was playing earnings. And this is, like, it's just not worth it. What happened was I put this contract on. That day, earnings came out. And the stock plummeted to, like, 103. Alright, so I'm going to pull out that calculator. And to get an idea of, like, how much the losses were at that point. 128, subtract 103. Like, this was after market. By the time the market opened, it was a little higher, but When I got home from work and I saw like the damage here, $25 of extrinsic value. Well, we know it's 100 shares, 2,500 per contract. So I got home, I was like, whoa, I just lost $15,000. Like, holy cow. My biggest loss before this point, or actually, this is still one of my biggest losses, was $240. So seeing that like scared me straight. Luckily, it came up a little bit when the market opened, but I closed this position for $6,200 loss, and I was grateful to get out for that after seeing what I was at. Now, I'm going to show you what I did try to do to try to manage it. Originally, you see I closed it. I opened up a new one. I was going to roll it out a month for a small credit to get more time to be right. But as I was thinking about it, I didn't really like Beyond Meat at 128, so that was mistake one. Playing a stock that you don't actually want to own. Stick to stuff you do want to own, so you don't lose confidence in the trade itself. Two, I traded too big, like 6 contracts. That doesn't leave me a lot of room to do other options. Like, trade small. I don't care how confident you are in this position. Keep it small. Spread your bets around. If you're trading at 70% probability and you do a trade on 10 stocks, maybe 3 go against you, then you can manage those 3. The other 7, you got money. Whereas here, if this one goes against me and it's my only trade, well, I'm pretty screwed here, you know? So keep it small. And 3, like, stay out of earnings. But back to on topic here, taking a loss. I decided to close this out. I got lucky, got a little profit back, or got a little of my money back, and redeploy that capital in other positions to make up that premium during that month. Like, this month was my best month in the end, even though I took my biggest loss ever, because I was able to redeploy that capital to earn back that money. You don't have to make back your money on the position that you lost it in. There's a guy in my trading group, and some of you probably already heard this about the don't get Roku. He had the same thing kind of happen, except on the call side. He sold some calls, and he just kept rolling in those calls. His capital was tied up, and basically he was trying to defend a losing trade for a long time that he should have put out to pasture. And instead of making money on other plays, his money was tied up on defending a losing trade. So sometimes taking a loss is your best decision that you can make at the time. All we can do is take the information we have available to us and make the best decision we can at the time. I am not a financial advisor. Any information included in this video is for informational and entertainment purposes only. It is not intended to be investment advice. Please seek a licensed professional for investment, tax, or legal advice.